Tulip Mania. It happened in the Dutch Republic in the 1630s, and it remains one of the strangest episodes in financial history. Tulips had recently arrived in Europe from the Ottoman Empire, and certain rare varieties became status symbols among the wealthy. Prices climbed, then speculators entered, buying bulbs not to plant them but to sell them at a higher price. Contracts for bulbs that hadn't even been harvested yet were trading hands. At the peak, a single rare bulb could cost more than a skilled craftsman earned in a year. Then, in February of 1637, buyers simply stopped showing up. Prices collapsed within days. Many who had borrowed to speculate were left with debts and bulbs worth almost nothing. The South Sea Bubble. In 1720, the South Sea Company held a British government-granted monopoly on trade with South America. The problem was that the trade barely existed. The company aggressively promoted itself anyway, and share prices rose dramatically on speculation and optimism alone. Members of Parliament held shares. The king was a governor. The excitement spread widely. When it became clear the underlying business couldn't justify the valuations, confidence broke. Shares collapsed from around £1,000 to under 100 within months. Thousands of British investors were ruined, including scientists, nobles, and merchants who had staked everything on the promise. The Panic of 1837. Andrew Jackson's administration had spent years dismantling the Second Bank of the United States, distrusting centralized financial power. The resulting environment allowed state banks to issue credit far beyond their reserves. Land speculation exploded, particularly in the American West. When the federal government required payment for public land in gold or silver rather than paper banknotes, the demand for hard currency caused a cascade of bank failures. Credit froze, businesses collapsed, unemployment climbed across American cities. The depression that followed lasted roughly 7 years, making it one of the longest economic contractions in American history up to that point. The Long Depression. It began in 1873, with a financial panic triggered by the collapse of railway investment bubbles in Europe and the United States simultaneously. The Vienna Stock Exchange crashed first. American banks followed shortly after. What made this depression unusual was its duration. Economic stagnation, falling prices, and high unemployment persisted in parts of the world for more than 2 decades. Prices for agricultural goods and industrial products dropped steadily, squeezing farmers and manufacturers alike. It reshaped global trade patterns, pushed governments toward protective tariffs, and contributed to widespread social and political unrest across multiple continents. The Great Depression. It started with the American stock market crash of October 1929. But the collapse that followed was far deeper and longer than any previous downturn. Banks failed by the thousands. Industrial output fell sharply. Unemployment in the United States reached 25%. Other countries, already financially weakened by the First World War, were pulled under as American banks called in international loans. Global trade contracted severely as nations raised tariffs in self-protection, making conditions worse for everyone. The Depression lasted through most of the 1930s and fundamentally changed how governments understood their role in managing economies. The oil crisis of 1973. When Arab members of OPEC imposed an oil embargo on countries that had supported Israel during the Yom Kippur War, the global economy encountered something it hadn't adequately prepared for: a sudden shortage of the energy source everything depended on. Oil prices quadrupled within months. Inflation surged. Long lines formed at gas stations across the United States and Western Europe. Industries built around cheap energy struggled to stay profitable. The crisis exposed how deeply modern economies had been built on the assumption that oil would remain both available and inexpensive. It triggered a decade of stagflation, the damaging combination of high inflation and slow growth occurring at the same time. The Latin American debt crisis. Throughout the 1970s, Latin American governments borrowed heavily from international banks, largely using petrodollars that had been recycled into the global financial system after the oil shock. The loans funded infrastructure and government spending. When the United States raised interest rates sharply in the early 1980s to combat inflation, the cost of servicing that debt became unbearable. Mexico announced in 1982 that it could no longer meet its obligations. Brazil, Argentina, and others followed. The International Monetary Fund stepped in with conditional bailouts, requiring painful austerity, cuts to public services, wage freezes, and currency devaluations that drove millions deeper into poverty across the region. The Japanese asset bubble. During the late 1980s, Japanese real estate and stock prices inflated to extraordinary levels. At its peak, the land under the Imperial Palace in Tokyo was theoretically worth more than the entire state of California. Banks lent aggressively against these inflated assets. When the Bank of Japan raised interest rates to cool the speculation, the bubble deflated rapidly. Asset prices fell sharply through the early 1990s, leaving banks holding enormous quantities of bad loans. Japan entered what became known as the Lost Decade, a prolonged period of stagnation, deflation, and financial paralysis from which full recovery took the better part of 30 years. The Asian financial crisis. It began in Thailand in 1997 when the government, unable to defend the baht against currency speculators, was forced to abandon its peg to the US dollar. The currency collapsed. The crisis spread rapidly to Indonesia, South Korea, Malaysia, and the Philippines. What had looked like strong, fast-growing economies were revealed to have large amounts of short-term foreign debt, weak financial regulation, and currencies that couldn't withstand sudden capital flight. The IMF imposed strict conditions on rescue packages. Millions lost jobs across the region. Indonesia's economy contracted by more than 13% in a single year. The dot-com crash. Through the late 1990s, investors poured money into internet companies at a speed that outpaced any rational assessment of their value. A company with a website, a business plan, and almost no revenue could raise hundreds of millions through a public offering. The Nasdaq index rose nearly 500% between 1995 and its peak in March 2000. Then the selling began. Companies that had never turned a profit ran out of cash. Many simply closed. Others shed nearly all of their market value within months. Trillions of dollars in paper wealth disappeared. The collapse was sharp and fast, though its economic damage was more contained than crises with deep banking sector involvement. The global financial crisis of 2008. American banks had spent years issuing mortgages to borrowers who couldn't realistically repay them, then packaging those mortgages into complex securities and selling them to investors around the world. Rating agencies gave many of these instruments their highest safety ratings. When American housing prices began to fall and mortgage defaults rose, the value of those securities became uncertain, then worthless. Major financial institutions that held them faced collapse. Lehman Brothers failed in September 2008, sending shockwaves through global credit markets. Governments intervened with enormous bailouts. The recession that followed cost tens of millions of jobs worldwide and took years to recover from in most countries. The European sovereign debt crisis. After the 2008 financial crisis, several European governments found themselves with unsustainable debt levels and shrinking economies. Greece was the most severe case. Its debt-to-GDP ratio was far higher than official figures had previously indicated, and bond markets responded by demanding much higher interest rates to continue lending. Ireland, Portugal, Spain, and Cyprus all required international assistance in varying degrees. Austerity programs, imposed as conditions of rescue packages, generated significant social unrest. The crisis tested the structural coherence of the eurozone and raised serious questions about whether countries sharing a currency but not a fiscal policy could survive severe economic divergence. The COVID-19 economic shock. In early 2020, the global economy was effectively paused by government responses to a pandemic. Travel stopped, businesses closed, supply chains fractured, unemployment rose faster in some countries than at any point since the Great Depression. Governments responded with spending on a scale rarely seen outside wartime. Direct payments to citizens, loans to businesses, and central bank interventions that kept credit markets from seizing entirely. Recovery came faster than many predicted in some sectors, but left lasting disruptions in others. Inflation followed as supply struggled to meet demand that returned faster than production could adjust.